Welcome to the daily update, where I'll go over the action in the market for Monday, November 4th, and then we'll see how things look for Tuesday, November 5th. Well, if you follow the political situation, the big day is here. I don't really know too many people who don't follow this area. When I was younger, it's like, okay, we've got an election coming up. We'll see who wins, who loses. Now it's become so divided and people feel so strongly on either side. It's a real point of contention. We don't know if we're actually going to find out on Tuesday who won or lost. Of course, I'm in Eastern Europe, so I'm 11 hours ahead of Pacific time. Maybe I'll find out earlier, but doesn't really work that way. We ended up having a slight down day on Monday. We are drifting more negative. We're negative in the short term because we're below the 20 period moving averages, but we're still holding out above the 50-day moving averages. So we're kind of in that in between land, but some of our indicators are still showing some weakness that's developing, but there's others that are still showing some strength. There's a thing called the SPX Investing Program. It's a program I have developed. It's free until the end of 2024. You can check that out. There's a link that will take you to the website. There's a link that will take you to a video. If you have any questions, you want to set up a time to talk, please feel free to email me. You do get access to the videos as soon as they are produced. And speaking of the videos, the daily video is the real foundation of the analysis that I do. And we can see incremental little changes, which that's what technical analysis is supposed to do. I don't use it to forecast. We just evaluate the current climate and say, okay, based on what we're seeing, it appears that the market should go up, down, or even sideways from here. And that's really how I implement this. If you want to learn more about that, I don't tell people what to do. What I'm trying to do is teach a skill in the program, and you can learn a lot of this by watching the daily videos. And then over the weekend is when I do the outside videos that you're also welcome to check out. Okay, so right at the open, we had a lower open. The futures were drifting off. Prices declined down to S1 at 57.11. And we were able to climb back above the unchanged level, but we hit resistance at the daily pivot at 57.42. Then we declined back below the unchanged level, so we drifted negative again. We got down to S1. We found support right around the 5,700 level, a nice round number. We rebounded, but now we hit resistance at the unchanged level, and that's a built-in support or resistance level. Didn't really work out earlier in the day, but it did provide resistance later in the day. We ended up closing just about at S1. We were down 0.28% on below average volume. Not a real surprise there. Didn't really have any major economic reports coming out. It's the day before the election. There's a lot of uncertainty. So people just decided, hey, I'm going to wait and deploy some money until things become a little bit more clear as far as the election. We are negative in the short term. We're still hanging on to being positive in the intermediate term, even though we're drifting with some of our indicators. I measure positive and negative by are we above or below the 50-day moving average. We're still positive in the long term. We'll have to see later on in the week with the Fed coming out, what are they going to do with interest rates? It's pretty much that they're going to cut them 25 basis points, especially after we saw that weaker than expected employment situation last Friday. All the data that we saw last week seemed to be stronger than expected, and then boom, we hit Friday much weaker than expected. That suggests that the economy might need a little bit of help, and so it's looking more like the Fed's going to cut rates again. And we'll just see how inflation goes forward. I have a new chart to show you later on that I'm actually going to add to the intermarket analysis video update. We want to keep an eye on the geopolitical things too. Yes, the U.S. election, that's really the focus of what's happening in the U.S., of course. But there's Russia, Ukraine, there's things going on between Iran and Israel, and that could have an impact on the market. Some comments. There was a real lack of conviction ahead of the election, and small caps actually did about the best in Monday's session. Mega caps and semiconductors underperformed in Monday's session. We're still above the 50-period moving averages. That's why we're hanging on to this positive look for the intermediate term. We're still under 22 at the VIX. Now, we're even though we're under 22 where we had been up and around 23, this is still above 20. So it's a very high VIX reading right now. Keeping an eye on the Middle East, oil did go up a bit. It's between 71 and $72 per barrel right now. Our usual charts that were suggesting that we're oversold. Now, as I've been pointing out, the bigger picture is still positive. So we want to keep an eye on these short-term indicators. When they become oversold, they may not last for very long. They may be able to bounce up because the bigger picture context is positive. But at the same time, we're seeing some intermediate term weakness, and I'll go through those charts. Here in the short term, we have the Stochc RSI, the Williams percent R, CCI 14 and 20, and the stochastics. And those are usually, they are either extreme positive or negative, depending on which way we're moving. We still have the Chaikin oscillator that's extreme negative, and our smart money indicators are still looking more negative as well. The basic scenario that we're going with is that the Fed, yeah, they've already come in and cut rates, and they're probably going to cut rates again at the next meeting, but not as much as they did the first time when they cut 0.5%. We're looking at 0.25% cut here. The dollar was down and interest rates were also down. That did give some support to stocks from actually falling apart completely, probably. It could have been a lot worse with both the dollar down and interest rates down. That gave some support. After Friday, we had closed at 4.36% with the 10-year yield. After Monday, we're at 4.31. Still quite high than where we were just not very long ago. About the time the Fed came in and started cutting rates, that's when interest rates started to go up. Yeah. We're still inverted with the 10 to the 3-month yield curve, where we are uninverted or back to being normal with the 10 to the 2-year yield curve. Sentiment is negative. We had been at 49, which is right around neutral. We dropped down with the more negative stance that we saw in Monday's session, where we're coming in at 43. So the context is that we're now going down with sentiment. We tend to follow that and go with that until it gets extreme. Extreme here would be getting down to around the 25 range, but we're quite a ways from that right now. We are negative with our trend. The red line's above the green line. We switched last Thursday to being negative. The ADX is weakening, but it's trying to turn back up, and it's not very far away from its moving average. But we're still in a trending environment since we're above 20. With the down day, the bias is negative, and I'm keeping our momentum at negative right now just because we're seeing some internal weakness currently. We had factory orders. That was the report in Monday's session, down 0.5% on a month-over-month basis. They expected it to be down 0.4%. Last time it was down 0.8%. If you take out transportation, it was up 0.1%, where last time it was down 0.2%. Here are some charts that go along with that economic report. Factory orders year over year are declining, actually negative when you measure it that way. And then when you look at the durable goods on a year over year basis, the things that last longer, they're also negative on a year over year basis. Non-durable goods, the things apparently that don't last very long, that you use up relatively quickly year over year, they're also negative. And I'm having a little difficult time here trying to move this around so I can see this chart. And then when you take out non-defense capital goods, taking out aircraft on a year-over-year basis, we're actually positive. So apparently they're not buying as many fighter jets right now. Okay, Isabel Net. Once a bull market gets to 2 years, and I love this, there could be a lot. Okay, a lot of what? They obviously chopped off the word here at the end of their title. But really, this is just showing that we're 2 years old. It was October of 2022 when we bottomed, and we've been coming up since then. We had another pretty significant bottom in October of 2023. Not really, I mean, we've done well since 2023, but really didn't have much of a bottom in October of 2024. We've just kind of been dangling. But really what this is trying to say is we still have some time left, according to history. Now, it doesn't mean we're going to go straight up. It just means that the last 2 years have been solid bull market gains, and that still could look positive going forward from here, in spite of what short and possibly even intermediate term weakness we're seeing right now. And equity fund flows this year have been very strong in sharp contrast. Here we have the election, and here we are right now. And they're calling this election week. And we're seeing money coming in. There was money coming in 2024. That's what we've been happening right now. We're seeing a lot more than what we were seeing back in from 2012, 2020, 2016. A lot more money coming in. So people are trying to front run this election, and then we typically see a lot more money coming in after election. Are we going to see a reversal of that this time? This is not what we have typically seen lately. So we at least be open to the idea that we may see the reverse of this after the election is over. Magnificent Seven stocks have underperformed since July. They peaked in July, is July 16th when they hit their high. And I've been trying to point this out along the way that they're holding up, but they're not leading things the way they were before. We're having a hard time getting back up here where the S&P is just coming off a little over a week ago, set an all-time high before seeing some more shorter-term weakness as of late. And net demand for U.S. equities going back to 2000, where you see corporations buying back a lot of their own stock here. That's where we're getting a lot of the support from. Not as much with the pensions or mutual funds. Households are up a little bit. Foreign investors are also up, but we're really seeing a lot of the growth with companies doing buybacks right now. And then we expect that shrinking contributions from shelter and private transportation services inflation will slow the headline CPI. This is just their prediction here at Goldman Sachs. They think that inflation is going to be coming down, and they try to give you some reasons for it. These are just the different areas that make up CPI. And so overall, they're looking at inflation continuing to drop. And this is when they made when we had the last CPI reading, and then what they see going forward from here. Could happen that way, could happen a completely different way. Then the financial conditions. When things are getting a little bit tighter, we're seeing rising interest rates. We've seen the dollar going back up a little bit, and then there's a whole lot of other factors that go into this. You notice how we bottomed around the 24th of September, and now we've been coming back up. It had been showing a looser conditional environment with the finances here, where now it's starting to go back up. This could be why we're seeing a little bit of weakness in the market. S&P 500 pulls back again on earnings disappointment. It's not that the earnings are necessarily disappointing. Over the weekend, FactSet still has us up. We're a little below average when you take the 5 and 10 year. It's a lot of these companies are coming out with pretty good reports, but they're seeing a run up of their stock before the earnings report is released, and then a sell off after the report comes out. Now, there's always exceptions to that, and you can always figure these things around about 3 or 4 different ways, depending on what your perspective is. But they're trying to show here from Bloomberg that that's why we're seeing a bit of the downturn. The earnings are good, but they're not blowing people away like they were before. All right, did find a few charts here. This is from Stock Traders Almanac. This shows the political alignment and what the performance is. You go over here on the left. These are all the years together, and we're usually up 9.3% from 1949 to 2023. Then you can go across the board here with all the different scenarios: a Republican president, Democratic president, Republican Congress, Democratic Congress, split between the two. And right here, they seem to be up a little bit more when we have a Republican Congress. And then here over, you see when it's split between the two, that's when the market does best, because Congress likes to get in and fiddle around with things and pass regulations and laws and make things more restrictive. Well, if it's split between Republican and Democrat, they can't do that as much. Now, the one change that we have seen over the last, 10, 15, 20 years is executive orders where the president is actually doing something. And then, of course, then it goes through the courts. And while it's working its way through the courts to determine if it's constitutional or not, then the courts decide about that. And then what's happened about in the last 20 years or so, the administration may even ignore what the courts say and still continue to do it anyway. But so it's not as by design necessarily. The U.S. was designed so that the president was just like a figurehead who didn't really have an awful lot of power. They could oversee the military, and that was about it. It's where Congress is. That's where the real power was supposed to reside because that's closest to the people. And we're really seeing a shift in that. And in some ways, it's always been that way. I mean, you can go back to Lincoln during the Civil War. He expanded a lot of the powers. You had Wilson during World War I. You had FDR during World War II. And then so it has become more and more of a power type of position as far as the president. But when the founders first came together, it really wasn't that way. They wanted it to be as close to the people, we the people, not you the president or you the king. They wanted to try to totally do away with that. And that's why they like some splits along the way, because usually the decisions that they make are not necessarily advantageous for companies or for the stock market. All right, then we see the same pretty much lineup here. For some reason, um, Stock Traders Almanac decided to have the Nasdaq as being purple. Isn't that really nice? A little bit of purple rain. Maybe they're Minnesota Vikings fans. Okay, then semiconductors. Now, this is from bar chart, but I'm not seeing this. I look at a chart of the semiconductor index every day. And he's seeing a death cross right here. And by he, I mean the person who posts here from bar chart. I'm not quite there yet. We still have a ways to go before we're dropping. Now, if you go back into 2022, this is where we saw the semiconductors were one of the first groups to cross back over positive, and then we saw things really start to improve from that point. And we actually hit the bottom here in October of 2022, but when we actually switch back over to a positive trend, there's a lag here because these are moving averages. And then we've been riding this up ever since then. And then we want to keep an eye on this, and I'll look at this chart every day and report it when I see a death cross if that happens. But if the semiconductors really show some weakness here, that could bleed through because they're a huge part of the tech sector. And the tech sector is the hugest part of the stock market for the S&P and for the NASDAQ and NASDAQ 100. Yeah, this is the new chart that I was showing. This is an ETF where you can actually invest in inflation expectations. So I've added this to my list because there's so many ETFs now. They're all over the place. But this is still suggesting that there's expectations going forward that inflation could pick up. Now, this is a weekly chart. You can see there's not, in fact, I don't even think they have any volume on here. It doesn't really trade. It's not all that liquid, and there's a lot of gaps in the data. That's why I decided to go with a weekly version on what I'm going to show as well. Okay, Yardeni had a couple of posts, and I went over this in the website with one of the videos that I post there that I don't share publicly. And this is looking at the 10-year bond yield. And notice when we bottom, that was right about the time the Fed came in and cut rates, and we've just been shooting back up. You'd think they would stabilize, if not even go down, but that's not what's been happening. What we're watching here is we had a high back in 2023 and then another high back earlier in 2024. We're watching this downward sloping trend line. Now, me personally, I think flat lines are more powerful than trend lines. You may disagree with that, but that's how I come out with things. And so we're getting close. Now, we did fall in Monday's session, and this is a little bit longer term chart. If we break above this trend line, that could end up showing that, okay, we're breaking to the upside as far as interest rates are concerned. And that previous chart about inflation, that would be more logical as to why that chart really hasn't been coming down, even though with the CPI and GDP and the core PC, even though those have been coming down, we're not really seeing it in that inflation expectations chart. Then another chart here just shows a real strong correlation between the economic surprise index when economic reports come out stronger than expected, and then what happens to the 10-year yield. And there's a real strong correlation. When the economic reports are weaker than expected, that's when we see interest rates going down. And we've been going through a season now where the economic reports typically have been stronger than expected, and that's been one of the reasons why we're seeing interest rates going back up. All right, let's look at the intraday chart here. Not a real exciting day. We did have a lower open, But then we quickly saw some buying coming back in. We went above the unchanged level, but we could not break out above the daily pivot. Chopped there for a while, then dropped down, went negative, fell down to S1, actually came down to about the 5,700 level, a little bit below that. This is just an area. But then we found some support, came back up, but could not get back above the unchanged level. Danced along the way there, drifted off, and closed just a little bit above S1. So not much of a change here. The futures were pretty subdued. We actually opened a little bit higher, and then as we got closer to the open, the futures started to drift down, and we're not seeing much of a change now. They're pretty much unchanged. I checked them right before I started recording this, but it's many hours before the market opens. And this is looking a little more negative, but also positive at the same time because the blue line is above the red line, even though the blue line and the red line are both declining. This is large cap growth versus value on a 10-minute intraday chart. And seeing the growth to value ratio bouncing back up a little bit here, but we saw that big drop off last Thursday, and so far, not much of an improvement intraday, but not much more weakness either. So end of day growth was down more than value for the large caps. It was up with the mid caps and about even with the small caps. So seeing a little bit of an improvement with small cap growth to value, but overall the ratio is declining. Also still in a decline with mid cap growth to value and coming back up showing a little bit of improvement with S&P growth to value ratio. But the positive takeaway is that we're still in an uptrend with this overall ratio. For this to continue to go up would be more positive for the S&P. If this continues to go down, that would be more negative. And we're still inside the rainbow, but coming up a little bit near the top end of it when we look at the growth versus value ETF. Discretionary to staples still holding up fairly well here. Not really seeing a lot of strength in discretionary. It's more the weakness that we've been seeing in staples. That's what's helping this overall ratio on this chart. Large cap growth was down a little over 1/3%, but still above its 50-day moving average. In our trend, we are going up again with the red line. We're going down with the green line. That means we're negative here. The ADX is trying to turn up, but we haven't quite crossed above the moving average yet. Also, just a little bit more, and we could actually cross above the moving average with the short-term ADX. If the red line's still on top, that would mean that we are in a strengthening negative trend. So we're keeping an eye on that one too. We dropped to below average with volume. Probably not a real surprise. Really no economic reports the day before the election. Just, who wants to tie up a lot of money and do a lot of work when who knows what the result is going to be over the next couple of days. Now, looking at the composite sentiment gauge that we look at once a week, we're still getting a pretty positive reading here with 66.55, where we're actually dropping to negative now with the CNN money sentiment gauge that we look at. Also, a little bit bullish here when we look at the legal insider transactions ratio. Now, illegal, just watch the first Wall Street movie. That's illegal insider trading when you act on information that's not publicly available. Legal insider transactions are like the CEO, corporate officers, people that founded the company that own a lot of stock. I mean, they have to report what they're doing. And we're not seeing it at a really high reading right now, which can often be more positive. And when I show the previous chart, that's when I show the insider buying ETF, which really has been going down lately and pretty much chopping sideways in 2024. The Ulcer Index trying to climb back above its moving average. That's when I start showing this chart. And also is confirming what we're seeing with the VIX is fear is going up. And we ticked up a little bit here. We're still below 22, but we're getting a very high reading above 20 now with the VIX, with the line chart and the bar chart. And the VIX of the VIX also went up with the bar chart as well as the line chart. The momentum of the VIX is up. And seasonality, we're getting a little bit outdated here with this chart, but we're probably back up into one of these high readings that we historically have seen near the beginning of November. Now, this is not generating a signal now. Whatever happened on Monday was enough to drop the SKU index back out of the red area. And that's why I'm showing this, is that I was pointing this out over the weekend. Now I won't be showing this chart as long as we don't go back up into that red area again. We declined with this fear gauge and we were up just a little bit with this other fear gauge. So seeing a little bit of contradiction here with our sentiment gauges. And we actually came off. Now we saw a lot of hedging going into Friday's session, but a lot of that hedging came off over the weekend. Maybe folks were anticipating something happening over the weekend that, I mean, there's lots of things happening, but nothing that really impacted the market. But when we look at the 5-day chart, we're still going up, and we're also going up with the 10-day chart. So the overall longer term trend of the equity put call ratio continues to go up, and that's more negative. Volatility risk premium still giving us a very high reading. That's also implementing or suggesting that fear, they're still anticipating fear going out 30 days into the future. And seeing a little bit of weakness, but we were flat with the advanced decline line based on price, but still above an advancing moving average. A little bit more of a decline here based on volume, but internally, this is still holding up for right now. And we're seeing a little few more new highs than what we saw on Friday. Really no new lows, but the 5 days going down and the 10-day is starting to flatten out slightly here. So this internal measure is still holding up. That's why we still just see this as a short-term pullback. It's why we're watching that 50-day moving average. That will change things if we close down below it. Accumulation distribution, smart money indicator, below the moving average. The moving average is starting to go down. That is negative. And seeing a little bit of an improvement, but still negative in the short term with the advanced decline ratio. And we're just barely positive here with the intermediate term advanced decline ratio. A little bit of an improvement here with the chicken money flow, but we're still negative, and the red line continues to go down. So this is our second smart money indicator that's negative, and we're still negative with the chicken oscillator, but we're getting to kind of an extreme reading here. But until it starts to turn back up, it's still more negative than positive. And we're negative with the vortex, with the red line crossing above the green line. And we saw a lot of this shift after last Thursday's decline. Not much of a change here with the advanced decline line, cumulative based on price for the S&P as well as volume. And we actually saw the broader market hold up a little bit better. The NYSE advanced decline line went up where the S&P was down. This is no longer extreme. We've been riding this, it seems like, for most of 2024. This is the 10-day average of the S&P 500 highs minus the lows. We were getting very high readings and just kind of camped out up here. Now it's starting to come back down. So we're not seeing that longer term momentum right now. And came back up a little bit with the cumulative advanced decline line for the NYSE, and just a little bit below the moving average with the regular advanced decline line for the NYSE. Also still a little bit below the moving average with this other NYSE advanced decline line. So a little bit of a tick up with common stock based on price, and barely any kind of an improvement here based on volume. So we're still under the moving average with the NYSE common stock. We're on the moving average with the S&P, bouncing up a little bit with the mid caps, showing an improvement, but still below the moving average with the small caps. And kind of not really seeing a lot of improvement here. These are the stocks inside of the S&P above their 20-day moving averages. This is why we're negative and we're below the 20-period moving average. Well, the stocks inside of the S&P are also below 50, so that is negative. And we're still below 50 with those stocks above their 50-day moving average, even though it tried to improve slightly. And we improved a little bit, but we're still positive with those stocks above their 100 and 200-day moving averages. So coming down and still hanging out around this 50-day moving average. Are we going to be able to bounce up off of that and start to go higher? If we fall down below it, that could turn things more negative. On the bottom, we were below average with volume. And a little bit of a tick down with the 20. We were flat with the 50, and a little bit of an improvement to slightly flat with the 200-day moving average of the S&P 500. Still extreme negative with the Stochk RSI, the Williams percent R, the CCI 14, and the CCI 20. These are our short-term indicators, and they're very touchy. We're looking extreme with the short-term stochastic, getting extreme with the intermediate short-term. We're crossing below the midpoint now with the longer-term stochastic. So all of these are negative, with the short and intermediate term being extreme negative. And still just a little bit below zero with the force index, but it's still below zero, so that's negative. The condition of the short-term trend is turning more negative with the 20-period moving average study that we do here. We're seeing both of the lines coming down and prices below both of the lines. And we're below the simple and exponential moving averages. That's why we're negative in the short term. We're below the midpoint, but not extreme. We're right on the border between the -1 and -2 trend channel with our standard deviations chart. Intermediate term actually ticked up a little bit with a balance of power, but comfortably and well below zero. So this chart is still negative. We're also turning more negative with the go, no go with the lighter blue bars, still hanging out near the lowest low value, which is the red line, and below the midpoint. The midpoint is also starting to roll over. TTM squeeze never did go positive, just drifting lower, 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 now even turning more negative. And we're still negative again here with the ease of movement based on the last 14 trading days. Still flat with the Arun. It hasn't picked up, hasn't woken up yet to see any changes. But if we go back here, we're still positive since the oscillator is above zero. And we're no longer extreme with the McClellan oscillator for the S&P. We had become extreme after Friday. We're still negative since we're below zero, but we saw a little bit of an improvement there. So we're declining with the summation index based on price and volume. A little bit of an improvement with the NYSE McClellan oscillator, but we're still below zero. When that's below zero, that means the summation index based on price and volume are continuing to decline. And going back down a little bit with the Swenlin trading oscillator based on price, but we're still below zero, so that's negative, and we are continuing to decline based on volume. So this chart is negative. The momentum is negative with the PMO going down, also going down based on price and volume. Saw a little bit of an improvement with the PMOs that are rising, flattening out with the buy signals, but still overall has been declining. We're also flattening out with the PMOs that are above zero. But when we look at the momentum in the short term, we're going down. We cross below the midpoint with the slope oscillator. The MACD is headed down. All of our oscillators, short, intermediate, and long term, are negative. Topic curve is also negative. We're more neutral but declining right now with the Sean trend meter, and we continue to be negative with the Elder's Impulse system for the S&P. We're negative for the third trading day now with the parabolic SAR. And we bounced up a little bit, but we're still below 50 with the money flow, and we're declining below 50 with the ultimate oscillator. So both of those charts, the money flow and the ultimate oscillator, are negative, slightly below the moving average with on-balance volume. Still below 50 with the RSI 14 and 9. That's more short to intermediate term negative. Still below both of the lines with the red line starting to cross below the blue line. And the longer we stay below these lines, the more these lines will roll over and go down. So that we're seeing some vulnerability to the 50-period moving average, which is the intermediate term. But we're still camped out right about at the simple and exponential moving averages. We have not closed down below that, at least yet. Here is the moving average tree below the 20s, still above or right about at the 50s, still going up with the 100 and 200-day moving averages. Still declining with the bullish percent index. Now, it's not officially negative until we get below 50, but the context is that we are negative since we are declining. Coming down also with the NYSE bullish percent index and actually crossing below 50 now with the NASDAQ 100 bullish percent index. And I switched out the little mini rainbow because we're below the 20-period moving averages there, but I wanted to keep an eye on the Ichimoku cloud. I have this in the support section of the video because of the clouds here. Now we're still above the cloud. What we're watching is this blue line is getting close to getting ready to cross below the red line. That could be more negative. We're also seeing the green line starting to go over as well. So even though this is a support chart, we're really watching this more for what's happening with the trend. We are negative with the Heiken Ashi with black candles. We're negative with the Kigi chart. It's red and pointing down. We're negative with the Renko with the red box. And we're negative with the three-line break. So our trend is showing some real vulnerability currently. And we saw enough of a downward move to draw a couple of O's in here with the point and figure chart. The buy signal, the triple or double or whatever it was, breakout that we were seeing, that's gone now. And it's being replaced by these zeros. X's are positive, O's are negative. But longer term, we're still looking positive. Long-term chart here, kind of coming around back up to the red line with the 150 and a little bit above it here with the 200-day moving average. The long-term trend is still looking solid. So we are negative in the short term with the S&P mid caps and the Nasdaq 100, where the small caps, they're still looking a little bit better. And we'll look at those charts here in just a moment. And then we're negative in the short term with stocks. Bonds are still negative in the short and intermediate term. Commodities, they've been all over here. They're positive in the short and intermediate term, and the dollar is positive in the short and intermediate term as well. And we saw energy, real estate, materials, and staples, more defensive areas. They ended up being positive. We saw utilities just getting smacked, which can also be defensive, but you could also make a case for it being a growth area with all the electric vehicles and Bitcoin and crypto mining and the switch to green stuff and all of that. But it just wasn't a real positive day across the board for the market. Saw a lot of the red right after the open. We read this from the bottom going up, and we saw the energy sector have a BPI cross below 50. So now that's officially negative. And real estate also crossed below 70. Now that's still positive, but the fact that it's going down is more negative. We had the NASDAQ go below 18.2, then it went back above 18.3, only to go above 18.1 and 18.2. It's chop, chop, chop. S&P went below 5,700. And then we saw Staples have a BPI cross back above 50, where they had just crossed back below 50. So real lot choppiness right now. We are negative in the short term with the decision point scorecard here, and we're positive with the trend model, and we're negative with the PMO signals. And as I was showing here, we were down a little bit with the S&P, but we were up slightly with the equal weight. So it slightly outperformed, but not all that massive. We're still underneath the 50-day moving average with the Dow. We are negative after being neutral with the diamonds. The NASDAQ just kind of chopping along sideways, just hanging out around this pivot point, which is like the decision point in the sand here, above, or the line in the sand, I should say. Above the pivot point would be positive, below the pivot point would be more negative. Also hanging out around this pivot point as well with the NASDAQ 100. We continue to be negative with the QQQs with the Elders Impulse system. The momentum for the NASDAQ 100 is still negative, and we're below the 20 period, but above the 50 period with the QQQs. Small caps, they were up 0.48%, trying to get back above their 50-day moving average with the small cap index. And we look at the Russell 2000 small cap index coming right back up to 50 with the RSI, still above its 50-day moving average on the price chart, but the momentum is still negative. And we've gone from negative to neutral with the small caps with the Elders Impulse system, kind of chopping sideways above their 50-day moving average with the mid caps, and they've gone from negative to neutral with the Elders Impulse system. The Wilshire also kind of hanging out just right above its 50-day moving average, as is the total U.S. stock ETF. So you can see across multiple indexes, this is an important level, and so far it's holding. We'll see if it's going to be able to break up out of that and turn positive or break below it. Staples to tech ratio, just chopping around quite a bit. We're not really getting any insight right now from this. The financial sector was down, but still above its 50-day moving average. The FANG index was down almost 0.5%, 0.43%, still above its 50-day moving average. We're still hanging out above this longer-term trend line. So for right now, that support level is holding. Apple was down 0.4%, dropping below its 50-day moving average. Amazon was down over 1%, still looking pretty solid though. And we have Microsoft dropping below its 50 and 200-day moving average. Now, we haven't seen a death cross yet. The blue line's still barely above the red line, but if that crosses negative, that may have a lot of folks making a decision to sell. And the financial media might make a big deal out of it. Google was down 1.2%, also kind of getting near a death cross, but we're still well above both the moving average lines there. Meta was down, still above barely its 50-day moving average, and Nvidia was up 0.48%. And Nvidia is going to be replacing Intel. I think it's November 8th. That'll be Friday. They're going to take out Intel, which used to be the darling back when I was first getting started decades ago. Intel was like one of the companies that you wanted to be a part of. Not so much anymore. Now, Nvidia is the new high flyer, so they're going to take Intel out of the Dow and put Nvidia in. And I think there's another like it's slipping me right now, but we just follow the Dow for information. Tesla was down almost 2.5%, but still above its 50-day moving average. Netflix barely unchanged, just kind of chopping sideways. Still looking pretty solid though. And we had been seeing a bit of an improvement between US stocks and world stocks. It's kind of going sideways here. Longer term, it is starting to flatten out with the correlation between the two. Oil did climb up. We're back into the 70 range now, watching that mainly for geopolitical reasons. And the dollar, it ended up being down. Now it trades 24.6, so that's why you're seeing a positive number here. But we're still hanging out above the 200-day moving average. And we were down with the 10-year yield, and we were up here with the 10-year based on price. Not much of a change with our growth to value ratios. The Qs to S&P right about on the moving average. Still holding up better with discretionary to S&P. On the moving average when we look at large cap growth versus large cap value, but the moving average is still ever so slightly going up. So the large caps kind of right on the moving average, seeing a little bit of an improvement, but a tick down in Monday's session with the mid caps and the small caps are above their moving average. Not really getting any conviction here with the S&P to utilities ratio. And coming back up a little bit with the staples to S&P, that would be more negative if this ratio continues to go up, but longer term, this ratio has been going down, and that's more positive for the S&P. So what's our outlook? We are still in the process of turning negative. We can't really say we're negative until we close below the 50-day moving average. And if we never do, then we might have a shot at turning back more positive since we're below the 20-period moving averages, but above the 50. And weakness is still growing, as I showed a lot in a lot of our smart money indicators, our intermediate term indicators are showing some weakness. We're going to get the trade balance, the S&P Global U.S. Services PMI. That'll be the final reading. ISM Services. That's probably going to be the big one that'll come out on Tuesday. And then all the geopolitical things with the U.S. election pretty much leading the list as it applies to the U.S. stock market. So then Wednesday will be kind of slow, at least as far as economic reports. Then Thursday is when things are going to really pick up. Jobless claims, productivity, and unit labor. And then at 2 p.m. Eastern is when the Fed will come out and do their thing and say if they did a rate cut and have the press conference and the information that they release. And then we're going to get consumer sentiment on Friday. So kind of a big block here for what's important on Tuesday. And with ISM kind of being the big thing there, of course, the election. Seasonality, we're positive with the Dow for November 5th. We're neutral to positive with the S&P and the NASDAQ. And Tuesday is a flip of the coin as far as how were we positive or negative in 2023, slightly positive so far in 2024. I finally got one of these from Tom Bowley for the month of November, but I still haven't received the Stock Traders Almanac daily chart. Utilities tend to be weak in November, where industrials tend to be better. And we're in that period now, November 1st through the 5th, where we usually get a pretty good start of the month. And then we go through a few days of being negative, and then we see from the 10th through the 13th up pretty good, and then a little bit of weakness. And then as we get closer to Thanksgiving, that's where we see a pretty solid finish. According to the research that he has here, we have airlines that do well, and trucking tends to also do well. They're trucking people to Thanksgiving, and they're flying turkeys around the world. Yes, I said that backwards. And we're seeing more of a drop off here with the buybacks during the blackout period here. That's becoming less and less of an issue. This is the Carson chart that's showing from November into the end of the year. We do have positive seasonality according to this. And then I'll probably take this away because we're getting up to the election now, where we tend to see a little bit of a decline going into the election and then a real move up after that, after election day. We'll see if that ends up happening this year. So what are the warning signs? We still have this confirmed Hindenburg Omen in the background. It's just kind of been sitting there for the time being. We're keeping an eye on staples, utilities, and healthcare, but they've been under some pressure lately. And we're watching energy mainly for geopolitical reasons, specifically oil. We're still going up with the 5 and 10-day equity put call ratios. Accumulation distribution, Chaikin money flow, and Chaikin oscillator. Our three smart money indicators are all negative, with the Chaikin oscillator being extreme. The 20 period and 50 period moving average studies, they're both below 50, so they are negative. Parabolic SCR, the Swenlin trading oscillator, and we're negative with the S&P and NYSE McClellan oscillators, as well as summation indexes. And our oscillators are negative, as well as the Copic curve. The vortex is negative, ease of movement, money flow, and ultimate oscillator, all negative right now. We're keeping an eye on growth of value, holding up better for the S&P than it is for the mid caps and small caps. And discretionary to staples is still hanging in there as well. And we are negative with the momentum of the NASDAQ 100, and we've dropped below 50 with the bullish percent index for the NASDAQ 100. So the positive signs, kind of a short list. And I'm measuring this by the S&P 500. We're pretty much on the moving average with the advanced decline line. The bullish percent indexes for the S&P and NYSE, they're still above 50, so they're technically positive, but they are both declining, so that would make them negative. And we're still looking okay with the financial sector. Our conclusion, I haven't changed it from what I came up with for Friday. We're in the process potentially of turning negative. We're seeing weakness coming into the market, but for right now, the 50-period moving averages are holding. We're negative in the short term. We're holding out above the 50-day moving averages in the intermediate term. We are still positive in the long term. Thank you. I hope you found this helpful. I hope you have a really good election day, and I will talk to you in the next video.